As the U.S. markets are closed for the weekend, United Parcel Service, or UPS, finished the week on Friday, October 31st, 2025, at a closing price of $96.43. This represented a solid move higher on the day, gaining $1.37, or about 1.44%. That closing figure came after a session that saw the stock trade in a range from a low of $94.58 to a high of $96.90, all on a volume of just over 7.3 million shares. Now, seeing a 1.5% gain on a Friday might not seem like a major event, but it's the context here that matters. This isn't just a simple upward drift. The reality of what's happening under the hood at UPS is far more complex than the headline numbers suggest. In fact, this recent price action is the latest chapter in a brutal tug-of-war between profound structural costs and a desperate push for high-margin efficiency. The common belief, the easy narrative you'll hear, is that UPS is just a bellwether for the economy. It's Brown, the company that delivers everything. If packages are moving, the economy is growing. If the stock is up, consumer spending is strong. That's the expectation. But the reality is that this view is dangerously simplistic. Treating UPS as a simple proxy for e-commerce growth is a mistake that many investors, especially those just doing some light online investing on the side, tend to make. The real story, the one that institutional desks at places like Fidelity are modeling, is about a company grappling with a massive unionized workforce and the corresponding wage pressures, while simultaneously trying to pivot its enormous logistics network toward more specialized, profitable areas like healthcare. The stock's recent volatility, including a massive 8% jump just a few days ago on October 28th, wasn't just about the broad market. It was about the market trying to figure out if UPS can actually pull off this transformation without its margins collapsing under the weight of its own operations. Let's look at that recent movement because it tells us so much. The stock has been trying to carve out a bottom for weeks, bouncing hard off a support level in the low 80s. That 52-week low of $82 is a critical line in the sand. The bulls are pointing to the fact that the stock has reclaimed the $90 level, a significant psychological and technical area. They see this as a sign that the worst of the selling, which began after the market fully digested the costs of its new labor agreement, is finally over. The volume on that 8% surge on the 28th was enormous, over 30 million shares traded, almost triple what we saw this past Friday. That signals a major clash between buyers and sellers, a potential capitulation moment. But then, just as quickly, the stock gave back 2.4% on Thursday before recovering on Friday. This is not stable, confident buying. This is a brawl. This kind of volatility scares away investors who prefer the smoother trend lines of a name like Apple stock. But for those doing serious self-investing, this is where the opportunity lies. The core tension is this. UPS management is aggressively pushing automation and network optimization. They are pouring billions into smart facilities, new aircraft, and data analytics to speed up sorting and reduce miles driven. This is the efficiency part of the story. On the other side, you have the new Teamsters contract, which delivered significant wage hikes. This is the cost part of the story. For the last several quarters, the market has been obsessed with the cost side, punishing the stock and sending it down from its 52-week high of over $138. The expectation was that these new costs would permanently impair profitability. The reality, however, is that UPS is simultaneously building a fortress in high-margin logistics, specifically healthcare. This isn't just about dropping a box of pills on a porch. We're talking about temperature-controlled, secure, and time-sensitive delivery of biologics, pharmaceuticals, and critical medical devices. This is a segment with high barriers to entry, sticky customers, and pricing power that e-commerce delivery simply doesn't have. This is where UPS is diverting its capital, and it's the part of the business that many retail traders, perhaps those checking their Robinhood app for a quick update, completely miss. They see a delivery company, but they don't see the complex cold chain logistics provider operating in the background. This high-growth segment is the company's answer to the bears. The question is whether it can grow fast enough to offset the margin pressure from its massive B2C e-commerce segment, which is in a constant price war with FedEx, the Postal Service, and the ever-looming threat of Amazon's own delivery network. Macroeconomic pressures are also twisting this story. While a strong consumer is generally good for UPS, the type of spending matters. A consumer buying a lot of cheap goods from overseas doesn't help UPS as much as strong B2B activity, where businesses are shipping high-value components and machinery. Furthermore, fuel prices have been a persistent headache. While UPS has fuel surcharges, there's a lag, and in a competitive environment, it can't always pass 100% of the cost on to the customer without losing volume. This is a delicate balancing act. When you look at the broader market, you see names like Nvidia stock soaring on a powerful, clear narrative about artificial intelligence. Tesla stock moves on its own distinct story of EV adoption and production scaling. UPS doesn't have that luxury. Its story is muddy, tied to diesel fuel, labor negotiations, industrial production data, and port backlogs. It's a complex investment that requires more than just a glance at a SoFi Invest dashboard. So let's briefly touch on the business model for those who aren't familiar. United Parcel Service is one of the world's largest package delivery companies. It operates a global network spanning more than 220 countries. Its business is broadly split into U.S. domestic package and international package, with a third, smaller segment called Supply Chain Solutions, which includes freight forwarding and those specialized healthcare logistics. For decades, its brown trucks and reputation for reliability made it a core holding, a buy-it-and-forget-it stock for a dividend portfolio. You could set up an individual brokerage account, buy UPS, and just let it sit. Past performance was solid, built on globalization and the rise of e-commerce. But the past is not the future. The expectation that this is your grandfather's stable dividend stock is now clashing with the reality of a company in deep transition. This is why you need sophisticated tools, perhaps like those offered by Interactive Brokers, to really track the options activity and institutional flow in a name like this. The flow is showing that while some long-term funds are holding, there is immense speculative activity betting on short-term swings. This is where I want to hear from you. It's a complicated picture, and everyone has a different thesis. Let me know in the comments. Are you holding UPS as a long-term dividend play, or are you actively trading it based on these economic shifts? Looking forward, the future outlook for UPS hinges on a few key scenarios. The bull case, the one where reality exceeds the currently pessimistic expectations, is that the company's multi-billion-dollar network automation drive, what it calls its better, not bigger framework, pays off. In this scenario, efficiency gains from technology and data analytics begin to visibly outpace the new higher labor costs. The high-margin healthcare and international B2B segments grow faster than anticipated, shifting the revenue mix toward more profitable streams. If this happens, the market will be forced to reevaluate UPS not as a struggling old-world industrial, but as a high-tech logistics backbone. In this world, the stock could move significantly higher, challenging those analyst targets near $120. But the bear case is equally plausible. In this scenario, the reality is that the new labor costs are a permanent anchor on margins. A slowing economy, particularly a downturn in industrial production or consumer spending, hits volumes hard. Competitors, especially Amazon, continue to siphon off the most profitable B2C routes, leaving UPS with the less efficient, more costly deliveries. This world, the healthcare segment fails to grow fast enough to matter, and the stock becomes a value trap. It looks cheap on paper, but continues to stagnate or bleed lower, perhaps even retesting that $82 low and breaking below it. This is the risk you take. This isn't an intelligent portfolio ETF. This is a single stock bet on operational execution. This is why understanding the company is so critical. Whether you're considering this for your Fidelity brokerage account or just watching it from the sidelines, the key takeaway is the gap between perception and fact. Many investors are still trading UPS based on the old narrative. The expectation is that it's a simple economic indicator. The reality is it's a complex operational battle. The stock's recent choppy movement from $82 to nearly $100 and now settling around $96 is the market's attempt to price in these two